Fear is contagious, not least in financial markets. When it turns to panic, it spreads fast in today's interconnected and technologically advanced trading world. Assets that are associated with some kind of risk fall in value, like what we have seen in global stock markets since coronavirus fears took hold. When panic moves across the world like this, there are only a few places to take shelter. These are referred to as safe havens. The list of safe haven assets is short and tends to include precious metals, bonds issued by countries seen as least likely to default in some currencies. Even though 2019 was not as bad as 2020, it has been described by investment analysts as a lively year for the global economy, with uncertainty over Brexit, the US-China trade war, and protests in Hong Kong just some of the issues investors had to grapple with. Some of these have a contagion and spillover effect around the world. On the local front, financial stocks, for example, struggled as a result of uncertainty associated with the financial sector cleanup. Fast forward to 2020, and the world has to deal with the coronavirus pandemic, which has seen investors moving their funds from stocks, some bonds, and even real estate into safer investment vehicles like gold, less volatile currencies, and stocks that will benefit from the crisis like health-related stocks during the current pandemic. Courage Buti is an economist with DataBank, and he explains the impact of the coronavirus on investor decisions in Ghana and around the world.
There is so much uncertainty. No one knows how long COVID is going to stay and how it's going to affect supply chain. So under such uncertain circumstances, they will want to move into safe haven assets, investments that are expected to retain or increase value during the times of market turbulence. It wasn't like the GSE was performing well before, but the expectation was that because the economy was picking up, the GSE will also move along. But then COVID struck, and then the sentiments all changed. So we saw in the early stages foreign investors in Ghana repatriating their investment, and they would ordinarily do so, sell out from markets they consider risky and assets they consider risky, and then lock themselves in positions they consider relatively safer that will preserve the value of their investment. And so GSE, I think year to date is down 17.54 on the composite index. And you look across the globe, markets like the British FTSE 100 is down 20%. The Japan's Nikkei is down by 6.5%. Australia's S&P and an ASX 200 is down 15%. So it's widespread.
Gold, for example, which lost its luster during some parts of last year, has rallied in recent months. It began 2019 at around $1,300 an ounce and ended the year at around $1,500. 8 months into 2020, however, and gold has surged to around $1,900 an ounce, making it a safe haven. On the currency front, less volatile examples like the Swiss franc and the Japanese yen have also become favorites for most investors. Here is Courage Buti again breaking down why local and international investors will opt for such safe havens.
Normally, when investors are moving, they will move to gold. They will move into the most stable currencies. They will move into the defensive stocks. Defensive stocks are stocks that, something like the pharmaceutical stocks, something like the consumer goods stocks, and then things like that. Whatever the situation is, whether there is crisis or not, people will still eat anyway, so the consumer stocks will do well. Pharmaceuticals, particularly now that we are in a health crisis, people will be paying too much particular attention to their health conditions now and will want to do everything to stay healthy. So the pharmaceuticals will be thriving. And so such stocks can be considered defensive stocks under this circumstance. Then gold. Gold has an intrinsic value, and then it's not like a printed currency that can fluctuate. And then so gold is considered safe haven. Central banks invest a lot into it, and an individual also to do so when they anticipate risk and want to cover against that risk. The currencies like the Japanese yen and then the Swiss franc. Swiss franc, because Switzerland, they have a well-functioning capital market that is resistant to volatilities, and it applies to Japanese yen also.
Hi guys, I hope you enjoyed this video. Subscribe to our Citi TV YouTube channel for more videos on the Business Dashboard.
Tune in and stay updated on the key business news stories of the day with Business Dashboard every weekday at 7 p.m. only on Citi TV.